Welcome to the Property Investing Roadmap podcast.
I would say once the thought is in your head, we would like to invest in some property, have the conversation.
Make time and discipline your friend.
I'm your host, Damian Collins, here to help you navigate the twists and turns of property investing.
The true investors are the ones that ask the right questions, but then make a very quick decision, and they're the truly wealthy ones.
For real success, you need a real strategy.
Buckle up as we hit the road with expert tips, real life stories, and the 9 key steps to help you plan, build, and optimize your property portfolio.
No one's going to invest to make a loss. You're going to make profit.
For those considering investing in property, the first question I usually get is, where do I start? I always generally recommend starting out in residential property, and there's a number of reasons for that during that accumulation phase of your property portfolio. Firstly, it carries strong potential for capital growth. We've seen lots of capital growth in residential properties over many, many decades in Australia. It's generally lower risk than other forms of property investment, such as offices, retail and industrial properties. And also a really important thing is that the lenders love it. You can generally borrow at least 80% and sometimes even more when you're buying not only your home, but also an investment property. But of course, the next question is, which residential property makes the best investment? Now, I'm delighted to be joined today by Mark Casey. Mark is a property acquisition specialist at Momentum Wealth. He's got a great portfolio. He's done very well out of property investing, and he's done very well for our clients as well. So he certainly knows a thing or two about investing in property. So thanks for joining us today, Mark.
Thanks, Damien. Thank you.
Let's get straight into it. How do you define a good property investment? Is it just about the financial return?
Great question. So return is part of it, the yield and return on the investment. The big part investors really want in the longer term is that capital growth. So the compounding growth over a period of time is really what helps create wealth. It's also about aligning your investment with your objective and financial needs and risk profile. So ultimately what makes a good investment is for the individual investor to get the right property that suits their risk strategy. What we really want them to do is unlock that capital growth over the longer term and make sure they hang on to it. Don't just have a short-term investment.
And that's so critical. We've seen it over the years that we've been not only running Momentum Wealth, but also I've seen it out there in other people as well. When you talk to them about it, it's the property and we're going to talk about that today, about land values and what's going to give you more capital growth. But often in a high growth, high land value property, you might see a really old house which is not in great condition. Your rental return might be low, and some people can't stomach that. It's really important what Mark said there about aligning your investment with your personal objectives. It's I get this question all the time: which is the best property to buy? Well, I can't answer that question because what might be good for me may not be right for you. But there are some important things that we want to give our listeners today in terms of what makes a better investment than another one, or at least the pros and cons of different types of residential investment. And what's your thoughts, Mark, on whether a new property or an older property is generally going to make a better residential property investment?
New properties do offer the depreciation benefits, lower holding cost. The downside to that is you get the lower capital growth. So what we really want as an investor is that blended yield and return. So we want to target a minimum sort of land value for the investor to maximise that growth over the longer term.
And that's so important. I think a lot of people don't do that comparative analysis. Yes, and there's people out there spruiking brand new property where you get depreciation benefits. Why wouldn't you invest in a new property? Well, the reason you get depreciation benefits is because those properties actually do depreciate. The building component does. Over the longer run, 40, 50 years, many properties that were built in 40 or 50 years ago in the 70s and 80s, they're in bulldoze condition now and not in great condition or need a complete refurbishment. So that's the reason you do get depreciation allowances, and it doesn't mean you don't buy necessarily brand new. You might, but if you've got a stronger cash flow bent, you might go to something newer. You're going to get the depreciation benefits, probably going to get better rent as well. But I think that's just important that people understand the difference in what you're buying, and that's where the land value comes into it. And I know when you buy properties, Mark, for our clients, you're certainly looking at what's the land value, because ultimately that's what goes up in value. And but it's not necessarily the land size, is it? It's not about just the biggest block. It's about the inherent land value. So tell me how that works generally in practice.
Good question. So the land value proportion of the purchase price you're paying, it depends on the age of the home, the situation in terms of location. If we look at, just as a case study, some different examples of properties. So if you're approximately 23 kilometres from the city in Perth, on about a 380 square metre block, a new house and land package around the $800,000 level, your percentage of land value on that purchase is about 45%, compared to something sort of 8 to 10 kilometres from the city, an older property, sort of 200, 250 square metre block, your land value on that probably close to that 60 to 70% land value. And then if you're around 11 k's from the city, 800 square metre block, your purchase price around the 750, you're close to the 80%. So the intrinsic land value on that property closer to the cities, it's got better location, better infrastructure, better transport connectivity, a lot better sort of economic drivers for the growth of that property over the short and longer term compared to the ones on the outskirts.
I think it's an important point. People don't always appreciate that even in a villa in a good location in one of our capital cities, maybe near the CBD, that can still have a very high component of inherent land value, even at the block size it might just be a couple of hundred metres, as you said there. And so I think people don't always think about that. It's not just about the land size, it's the inherent land value, particularly of, and what percentage of that is. We generally aim for 50%, I think, where we can, or more, but ultimately still it comes down to the investor's unique circumstances. And so when you think that through, do you think, well, apartments don't have any land underneath them, do they? Should I avoid apartments, or can apartments still be a decent investment?
If you were going to look at an apartment, you want to look at a smaller complex with a larger land component, probably an older complex. But if you bought a new apartment, then your land value is very small compared to the overall purchase price, compared to buying an older house further out, or similar, shorter distance from the city, say 4 kilometres out, 600 square metre block. If we look at a brief case study on that, Damian, back in around 1999 in Perth, off the plan purchase price around $255,000. The sale value of that same property in 2023 around $424,000. So not that great growth over that period of time, over that period 20 years plus, compared to a block 4 kilometres from the city, 3x1. Paid similar value around the same time, $260,000. That property sold in mid 2023 for about $1 million. So significantly greater capital growth on that intrinsic land value.
Yeah, and that's a huge amount. I mean, we're talking about 170,000 capital growth versus 750,000. So a substantial difference. Now, on the apartment, they might have got depreciation benefits. They would have been helped with their cash flow. The rental yield might have even been better. All those sort of things come into play, but isn't it, Mark, about understanding what you're buying? So if you know you're buying a brand new apartment, the reality is you're buying a very high percentage of the building, much lower percentage of what is there is the inherent land value, and then you are likely to get less capital growth. So you just got to understand that, and then you're not comparing apples and apples, just two completely different properties, are you?
Absolutely. So there's about a $600,000 difference in that end value there. And like you say, you do get the depreciation benefits, but you've got to adjust that on your sale value too.
We're talking about land and how important that is. So why wouldn't I just go out and buy a block of land? It's got no building on it. It's not going to give me headaches. I don't have to maintain it. I might have to cut the grass every so often, but I don't have to deal with tenants and all that sort of stuff. Why wouldn't I just go and buy vacant land?
So it comes back to the holding cost as well for that property. So you're not going to get any rental return off that property. You've got to hold on to it. Obviously, the interest cost, you'd have to chat to your accountant whether that was tax deductible or not, potentially be added to the cost base. So it does increase the inherent holding cost of that property. Also, too, if you're going to buy land, I guess close to the city, there is no land available unless you're buying a small block sitting on it. So generally be on the outskirts, so your inherent growth is less. It's not something we'd recommend for investors, just buying land and sitting on it. For owner-occupiers to build, it is quite different. But for investors, it's better off having that rental yield and growth.
Yeah, so maybe a property that's depending on their circumstances, but at least you're getting that rental income. And as you mentioned, unfortunately they've changed the tax laws. So if you go and borrow money to buy a vacant block of land and you're not renting it out, and they've even made that stricter now, you've got to basically have a finished house on it before you can start claiming the interest. You don't get any tax deductions for it. The borrowing is much harder because when the lenders look at your borrowing capability, if it's got rentable property on it, obviously they take that into account. So, look, yeah, obviously you're getting pure capital growth, but from a financial point of view, our philosophy is certainly let's go and buy a good quality investment property, might be 20, 30 years old, whatever that might be, but at least it's something you're getting a rental income from, because that helps with your servicing of your debt, helps with your tax benefits as well. So that's why we don't generally buy vacant land. Now, we've talked a bit about there, and some of the examples you gave of what's the best suburb. Should I be buying close to the city? There's a whole lot of things about, should I buy in the same suburb I live in? And often we do see people like to do that. So what are the benefits of looking beyond not only just your home suburb, but also in another state or a region around Australia?
Great question. So it just opens up your investment opportunities. So I guess as an investor, for their first one, they might buy in their own state. As they build their portfolio, it's good to look at diversifying. That might be around the state itself, so intrastate or interstate. But a lot of people do think the best property investment is in their own suburb. As you and I know, Damian, it's not always the case. You've got to look at a lot of factors, so school zones, employment drivers, infrastructure. So you want to really open up your investment horizons to outside your own capital city and other investment opportunities as well. So looking at where the best long-term growth is going to be.
And I get why people are obviously biased to their home city at least, because that's just human nature and inherent that we want to buy something that we understand the market, even if we've got a great buyer's agent representing us. But if you're betting in your own suburb, you're really betting the farm on your local area, because your own home value is going to be affected by what's going on in your local area. And then on top of that, you've got an investment property. So certainly, and I guess that's the benefit of having a buyer's agent who's out there. They're not biased to any particular location or where you live, or you want to drive past it on the way home. It's just so important. You've got to have that broad spread of areas to think about. And you look at, if you're building a larger property portfolio, you certainly have to think about outside your home state as well. So good advice there, Mark. Now, but when you're looking at the best suburbs, and this is obviously the detailed research that they do at Momentum Wealth, and obviously you guys do as well, what are some of the factors that go into choosing which is the best suburbs and cities to invest in?
So we want to look at the economic drivers in that area and location. Importantly, look at population growth, look at employment trends and what's happening in that area. Obviously, the infrastructure spend from private individuals and government in that area. Look at activity and employment hubs and zoning changes. So it might be currently R20 or going to a higher zoning in future, mixed-use zoning. Another important factor too in terms of when investing is to look at the proportion of owner-occupiers and investors. So one thing we generally do is make sure it's got a strong stability of owner-occupier base there. So you've got that stability in the price growth. Owner-occupiers compete for property, so they'll be driving to get into those areas. Also school zones. So we all know that there's a lot of very good public school catchments, and people are prepared to pay pretty heavy prices to get in those catchments, Damian. So
I just want to touch on a couple of things there, and you mentioned it. So certainly on a city level basis, you're looking for a strong economy and population growth coming into that city, and lots of jobs, lots of money getting spent on infrastructure. That's driving more people coming here, driving efficiencies. And I might come back to infrastructure, but I want to talk about population growth at a suburb level, because I see that as some of the developers and look, they've got to sell the story, but they say, look, this is they talk about outer suburbs in particular, and I won't mention them, but any capital city around the country that'll be the same, that they'll be saying, oh great, well this suburb is one of the fastest growing suburbs in the country or in the state or whatever that might mean. Do you want to just explain why that's actually not a good factor and it's a bad factor?
Those areas have a lot of land out there in terms of future growth. It's going to probably impede their development and growth potential until it's fully built out, whereas the areas close to the city are going through that rejuvenation, rebuild, as we're seeing now too. Even the schools that were knocked down within sort of 20 kilometres of Perth, they're being rebuilt. A suburb like Duncraig, popular family owner-occupier suburbs, got about 2,000 kids at the school now, but they're putting extra transporters, they're expanding the school rapidly. So a lot of these areas that are already fully built out are expanding with the rezoning that's happening, whereas those areas on the outskirts, they're getting growth through the population increase, but they've got a lot of vacant land, so it's going to realistically take a while before they get genuine growth.
Yeah, and that's it. It's supply and demand. So when I see a suburb, if I see a capital city's growing strongly, which many are in Australia, well, that's great because that's more people coming to that capital city. But when I see it on a suburb level, and they say, well, this particular suburb's going to double in population from 10,000 to 20,000, well, we know that's actually a bad sign, because to house those extra 10,000 people, it means there's all those blocks of land coming available. And sure enough, we've seen in the downturns those areas don't go very well. Whereas you talk about we want to buy in a suburb, and you mentioned one there that it's got really strong demand drivers, but there's really no land, and there's only a little bit of infill. That's what drives the capital growth, isn't it? That strong
Absolutely.
demand and very limited supply.
Yeah, and you look at those areas that are close to the city in good school catchments, they've usually got fairly limited rental available, whereas the suburbs on the outskirts, if you look at somewhere like Baldivis in Perth, there's probably 100 rentals at the moment compared to the areas within 15 to 20 kilometres where you're struggling to probably get 5 to 10.
I know you do a lot of work for interstate buyers, and so explain how that process works. I guess they're coming to you to get your expertise about where's a good place to buy, and so what are tell me that process of working with an interstate buyer, how you go through that, what sort of education process you go through, and just some of the key important legislation things you talk to them about, and what's different in Western Australia versus other capital cities.
So from a buyer's agent perspective, we've got complexities at the state level, and then we drill down to the local government area. We've got individual zoning. The rules with the R codes aren't generally consistent within the different councils, what you can and can't do in different areas. So there's a definite understanding of what you're buying, understanding what you can do with that property in future. And then when you get to the legislation of property management, it's quite different between different states. So it's good to have experts in your corner from the buying, from the property management side, and obviously even the settlement agents here. We have settlement agents over east. They use lawyers in terms of the settlement process. So you really need to understand the full process of what you're doing when you're purchasing interstate, and the complexities that go with it.
And we do sometimes see, don't we? We see buyers agents who are not really understanding the local market. They hear a market's hot, they jump in, and we won't mention the suburbs, but you and I know those suburbs that they've gone in with their ears pinned back and bought up everything they possibly can. I think some of those suburbs have run way too far, and they're going to be the first ones that hurt, aren't they? When the tide inevitably turns.
Yeah, and you can see the areas that are on the outskirts, where like we were saying before, where there's a lot more rentals, whereas close to the city you don't get that. So
yeah, and I think that's. And you mentioned earlier on the percentage of owner-occupiers. When I remember growing up, and when I first got into property, they said when times get tough, the first thing that goes is the holiday house, and the second thing that goes is the investment property. The primary residence is the one that people just stick it out. They keep paying the mortgage, they scrimp and they save. They don't generally want to let that go. But the areas with high levels of investment property or holiday areas, they're the ones people just cut and run and go, well, I can live without that. I still need my primary residence. So that's why it's so important, isn't it, to be understanding, not only in a complex of, if you're buying in a complex of how many are owner-occupiers, but also on a suburb level, isn't it?
Absolutely, yeah. And you find the owner-occupiers, they're prepared to spend the money on the property. They're staying there long-term. They'll generally move in for 10, 15, 20 years plus. So they do create a lot of rejuvenation throughout the suburbs.
Now, Mark, I know personally you've invested in some regional areas, and our sister company Westbridge has bought a lot of property in mining towns and done very well out of it, buying at the right stage of the cycle. But tell me, if you're going to go into a mining town or a town that is perhaps very concentrated in one industry, what are some of the things that you need to think about, and also who this might be suitable for?
I don't think it's something that would be suitable for a first-time investor. I think you need to be a little bit more sophisticated, so maybe second, third, or probably ideally third or fourth, fifth. In terms of when you buy, it's important to understand the cycles, which obviously it's pretty hard for anyone to get it perfectly right, but you want to really buy obviously when the values of the property are below replacement value. If they're obviously a fair bit below replacement value, you're protected. Just on mining towns too, Damian, I think it's good to target towns that have a diversification if you can, rather than just a single mine. So if we look at somewhere locally, say in Karratha, you've got the LNG projects, you've got the iron ore, you've got the fertiliser plants, you've got Dampier Salt, you've got a Burrup fertiliser plant that's being built up there at the moment. That's $5 billion. You've got Woodside expanding the Pluto operation. That's about 15, 16 billion. So these towns now have grown to more of a family, owner-occupier, family-friendly town as against some of the smaller towns. And obviously WA's got them, Queensland's got them, where there's one mine in the town. So they're high risk, certainly not an area we'd look at. And you've got to, like we said, like you mentioned, Damian, maybe earlier, in terms of investing in these towns, we have, for the clients with the right risk profile, back in 18, 19, we did buy in there, and those clients have obviously done well. They were well below the market value at that point in time.
Mining towns, certainly from our philosophy, are and these locations are a time to get in, but also thinking about a time to get out as well. And it's not for the faint-hearted. The returns, the rental yields are much stronger than they would be in a capital city, but it's that volatility. And we bought some in our sister company, Westbridge. Bought a bunch of villas at $135,000 each in South Headland, and 2.5 years later we were able to exit those in the $320,000 type range. So, but having said that, people who bought in the mining boom back in 2012, who paid nearly $1 million for houses, were struggling to sell them for $250,000, and unfortunately a lot of people lost the lot. So, Mark, you've bought lots of property not only for yourself but also for clients. You bought hundreds and hundreds of properties. So, when you look back on your own investment journey, is there one property that you've purchased personally that stands out as being your best investment? And then perhaps you can tell us there's a particular client one you think that there has been a particularly strong investment.
Probably similar to your own investing, and as you'd probably remember yourself when you started, it's the psychology of investing. So I started with a couple of units, but in terms of some of my favourites, probably when I had the confidence to go into development sites, bought one back in 2002, East Vic Park, waited a couple of years, developed it 2004, 2005. That comes back to, I guess, the fundamentals of property investing, getting as close as you can to the city, so key infrastructure, key economic drivers, lifestyle factors, good schools. That was a fantastic property, Damien. Also bought one up in Karratha. Did a lot of research at the time, 2003. I was in the mining space, which was good working in that space. So that one has performed exceptionally well. Like you said, buying back in 2003 was a good time to buy. That was the first one I bought up there, but that wasn't my first property. That was my fifth property. So at the time had people saying, why the heck are you buying in Karratha? But it's been a great property. It did sort of go up to probably from 350 up to $1 million by 2010, held on to it. The challenge at that time was the rents were about $2,000 a week, Damien, so it was spinning off good rent, held on, it came back to about $550, but that's now back up to $1,250, $1,300. So it's been a great property. I've paid it off gradually and it's still got a bit of debt on it, but it's been a great investment. But fortunately the timing was good and I've held in there, so it's well below replacement value. In terms of good properties for clients, good question. There's been lots, and generally it's about buying the right property and holding on, as you and I know, through the cycles. Those clients that have done really well, quite a few interstate investors have bought good development sites, have sat on them, done retain and builds, or near city developments where they've unlocked the land value and now they're obviously generating good rental returns. So some in East Vic Park and even some up near Joondalup where we've done retain and builds and those sort of things. So the key is, but it comes back to, I think, for the investor to have that mindset and hold on long term through the cycles. Yeah,
and I certainly know, Mark, based on the amount of repeat clients who keep coming back, that you've done very well at selecting them some great properties and the lots of referrals you get. So, listeners, we've learned today the best residential property investment for you really depends on a range of factors that are specific to you. If you're starting out in the accumulation phase, you generally want to be looking for properties that give you some good solid growth, but might be a bit lower risk, so you're still getting a reasonable rental return and you're not going to get slugged with substantial renovation and or maintenance costs. Ultimately though, the right property for you is the one that fits your goals, your risk levels and your unique needs as an investor. Thanks for tuning in. If you're enjoying the podcast, please take a moment to rate us to help others discover the show. Please note the information shared on Property Investing Roadmap is general in nature and doesn't take into account your individual circumstances. The information is for educational purposes only and should not be relied upon for investment or financial decisions. Always seek professional advice before deciding whether to invest. Today's guests are representatives of Momentum Wealth Property Advisory Proprietary Limited, licensed real estate and business agent in WA, RA 82976.